Hi friends, welcome to Consistent Trader. In this video, we are gonna see about the basics of options. Come, let's get into the video. So first of all, what is an option? An option is a contract which gives the buyer the right but not the obligation to buy or sell an underlying asset at a specific time. So what does this means? For example, let us consider you are gonna buy a land which costs about one which costs about 1 lakh rupees. You are paying an advance of 10,000 rupees and you both are making a contract saying that you are gonna buy that land for 1 lakh rupees after 6 or 7 months. So you have a time of 6 months. Within that 6 months, if the land value get increases, you may be profitable. So the contract made by you is called as an option contract. Now let's get into the second part. What are the types of options? There are two types of options. One is a call option and another one is a put option. So what is a call option? If you buy a call option, you have a view that the underlying asset or the stock may increase in value. If your view is that you are gonna buy a call option. For example, if your view is that Nifty is gonna reach 16,100 within this week, you will buy 16,100 call option. So what is a put option? Put option is an option contract which is opposite to the call option. This means that your view is that the option's price may go down. If your view is that the option price may go down, then it is called as a put. What is a put option? Put option is the opposite of call option. In this, you will buy a put option only when your view is that the price of the underlying may drop. So if this is your view, then you are going to buy a put option. What are the option? What are the next is the types of option styles. So what are the types of option styles? Number one is an European option. What is an European option? European option can be exercised only on expiration, whereas American option can be exercised even on or before the expiry. So in India, we use European option. The name CE means call option European style. PE means put option European style. Before learning this, before learning the option setup, you must know few important terms related to the options market. First one is strike price. What is a strike price? Strike price is a price at which the contract is now trading. For example, in case if Nifty is trading at 16,000, then if you are gonna buy at 16,000 call option, then 16,000 is called as a strike price. If you What is a strike price? Next is option premium. What is an option premium price? It is the price at which the strike is trading. For example, in case if you buy an option of 16,100 put option At what price does the 16,100 put option is trading is the option premium price. Next is the factors that determines the option premium. The major factors that determines the option premium is the price of the underlying security. For example, in case if you buy Nifty, the Nifty price increases or decreases, it will affect the option premium. Then based on the time, if the time between the time when you buy, based on the time difference between the expiration day and the day you are gonna buy. And then volatility signifies that if the movement in the price is quicker or normal, if there's a huge volatility in the market, then the option premium may get changed based on the volatility also. What is next? What is an intrinsic value? Next is intrinsic value. Intrinsic value is nothing but the maximum value that you can buy the asset without making any losses in the future. Then what is extrinsic value? Extrinsic value is calculated by taking the difference between the intrinsic value and minus the time decay or theta. I'll explain what is theta in the next coming slides. Theta decay. So if you buy an option, it has a time value. So options premium price get reduced and finally becomes zero on the expiration day. The rate at which the options premium reduce is called as the theta decay or time decay. Theta decay is an important term when you are doing an option selling. And options expiry day. Every options expires worthless at the end of the at the end of the at the expiry day. So there are two types of expiries. One is weekly expiry, then other one is monthly expiry. In stocks, you don't have weekly expiries, you only have monthly expiries. So every Thursday is a weekly expiry and every last Thursday of the month is the monthly expiry. So in case if there is a holiday on the Thursday, the expiry may be postponed to Wednesday or maybe sometimes to Wednesday. So if similarly to the monthly options also. Similarly to the monthly options also. What are the types of options contracts? One is at the money. At the money means the current value of the underlying stock or index. If Nifty is trading at 16,100 now, then at the money strike price is 16,100. Next is in the money. In the money means in call option. In the money means an option strike price which is below the current market price. In put option, it's the strike price which is trading above the current market price. Out of the money is opposite to in the money. It's nothing but in call option, out of the money is is when a strike is above the current market price, it's out of the money call. In put option, when the strike is below the underlying current market price, then it's called as put option. Sorry, then it's called as out of the money put option. So what is an option buying and selling? An option buyer actually pays the premium, whereas the option seller receives the premium. And option buying is like buying a lottery. You will have a 1 in 100 or 200 chances of getting success, whereas option selling is similar. Whereas option selling is like owning a lottery company, where you collect the premium price of the lotteries and you will make money. So why do you need to do option selling? In options buying, you can make money only when the price moves in your favor. Either if you buy a call option, when the price moves above, when the price increases, then you will make only then you will make the money. If you buy a put option, when the price falls, you will make a money. But in option selling, you will make money when the price moves in your direction and also when there is no movement in the price. This is because of the theta decay or time decay. You can easily generate a passive income using option selling setups, and the probability may be higher when compared to option buying. And almost, this is my view, most of the big players are option sellers only. So these are the basics you need to know before joining the course. Hope you all understand. If you have any doubts, you can message us.